So someone just asked, how have our clients reacted to some of the changes going on, and have we been proposing any changes to client portfolios, or should I be making any changes to my portfolio in reaction to what's gone on over the last several weeks and months?
Yeah, and I think this is another one where this happens when there's good news as well. Get back to the late '90s when the dot-com stocks were all the rage. And everyone looked at it and said, "My goodness, my neighbor he just told me he made a killing on some pets.com, were the ones that flamed out with the sock puppet." Going back a few years to showing my age, but this idea that I should be doing something. Either there's a bunch of good news out there, or in this case, a lot of bad news. I guess I should do something, and it's a natural reaction to have, but it's not the reaction you should have, because portfolios are built. First of all, they're tied to goals. And so if you're going to decide to invest, that is not a day-to-day decision. That's not a casino type of decision. It's a long-term decision. You probably have long-term goals, and you may need a portfolio to help support those. You need the growth that the stocks can give you over the long haul. So if you have a goal that's 5 years out, 10 years out, then you would put a portfolio together that would reflect what may happen in that time horizon with the markets. And over a 10-year horizon, you can be fairly confident, and I can't say guaranteed, but over 10-year periods, I think if you go back and look at the last set of 10-year rolling periods, 77 out of 79 10-year periods, you would have made money in stocks. And so when you look at it that way and say, okay, if I've got a 10-year goal and a 10-year horizon, I shouldn't have to make any changes to my portfolio just because this happened. The reality is that about once every 5 years, on average, the stock market has a very big negative event. We call that a bear market. Definition of a bear market is stocks dropping 20% from where they were. And actually, on average, the drop isn't 20 when we go into bear market, it's actually 30%. And lo and behold, that's exactly how much stocks went down in this last episode. Again, very unprecedented thing that took place, and the reaction of what we did to try to slow this thing down was also very unprecedented. We've damaged the economy in doing so. But it's not an unusual event, historically speaking, from a stock market perspective. And so the answer to the question was, do Oxford's clients, have there been a lot of changes made? The answer is no. The reason is we knew that something like this, we didn't know exactly what it would be and when it would happen, but we knew these things come up with some regularity. And so the portfolios were built in anticipation of this type of volatility rather than a reaction to it.